Well, welcome back, everybody. It's 11:15, so we're going to get on to our next agenda item. My name is Scott McMahon. I'm a senior lobbyist with Flaherty and Hood and work on mostly economic development issues with the coalition. We are excited to welcome Joe Mahon from the Federal Reserve to help us think through what the economy is going to look like as we move forward and what all of you as city leaders need to be thinking about as the pandemic, hopefully soon, starts to go away, our economy continues to recover, and we deal with economic realities for the next 12 to 24 months. As a quick introduction to our event here, Joe's going to present here for 25 minutes or so, and then we're going to have a conversation with him. I asked that if you have a question that comes up during the presentation, please post it in the chat function. We'll be compiling them, and then I'll be posing them to Joe at the end of his presentation. So I encourage you, if you do have a question, make sure to post it before Joe wraps up, rather than during the Q&A portion. For introduction of Joe, Joe is an economist with the Federal Reserve Bank here in Minnesota. He's served at the Federal Reserve for the past 17 years in a number of capacities. Currently, he is a regional outreach director. Prior to that, he was a regional economist and a staff writer and analyst for the Minneapolis Fed publications, The Region and Federal Gazette. In addition to these roles, he spends a lot of time looking at issues that are near and dear to our hearts in greater Minnesota, including agriculture, manufacturing, energy, and mining. And since you would much rather listen to Joe than listen to me at this point, I will turn things over to Joe for his presentation. Thank you, Joe.
Well, thanks, Scott, and thanks for the invitation to speak with this group today. I have a lot of material in my slides. I'm not going to go through it all because I want to leave plenty of time for discussion. So some of it I might skip over and return to if questions that are sort of pertinent to it come up. So Scott kind of covered what I'm going to be talking about. I'm going to really focus on what the impact of the pandemic is on the economy and share some indications of our outlook, but kind of major theme that I'll have for you is that the outlook is heavily dependent on the course of the virus and how quickly we can sort of get the progress of it arrested and potentially get a vaccine rolled out. So let's keep our fingers crossed on that one. So I just want to start with a quick disclaimer, just sort of standard thing our lawyers like us to say when I'm out speaking publicly. Federal Reserve is a nonpartisan institution. We're kind of an independent entity sort of that operates as a public-private partnership, and we try and stay out of politics. That doesn't mean that those of us who work for the Fed don't have opinions of our own, but if I do express any kind of any sort of controversial or stupid opinions, they're mine and not the Fed's. Or at least I'm not necessarily speaking for the Fed. So what I'm going to talk about today is the challenge that this pandemic has presented for us in trying to keep up with what exactly its impact is on the economy, because the situation has been changing so rapidly. It's such a large shock to the economy and happened so quick, and both of those, kind of both the size of it and the speed of it, were really unprecedented. Then I'm going to talk a little bit about some of the methods that we've taken to try and get a grip on those questions, and in particular, I'm going to talk about some of our survey work that we do. Our mode of combining kind of the standard macroeconomic data that we look at and supplementing it with sort of new indicators that we have. I'm going to share the results from a couple surveys that I have that I think I hopefully will be of interest to those of you in the audience, particularly our agricultural conditions survey that we just released last week, and a survey on conditions in the construction sector. And then I'm going to talk about some of the kind of real-time indicators that we have featured on our webpage, which is at minneapolisfed.org. You'll hear me plug that several times. We have a COVID dashboard up that kind of shows a lot of high frequency indicators of the path of the economy in response to this, and I'll show you some indications of that. And then, like I said, I'll try to leave plenty of time for questions. Just a quick level set for those of you who are sort of unfamiliar, maybe exactly with what the Fed is and what we do. We're America's central bank. We're kind of unique among central banks around the world in that we're a decentralized central bank. So when the Fed was created from the Federal Reserve Act in the early 20th century, they decided to kind of take into account some historical experience in the United States and our sort of tradition of distrusting large concentrations of financial power. And they divided the country up into Federal Reserve districts. And there are 12 of them. You can see that map there. And when I talk about our region, I'm talking about the 9th Federal Reserve District. So the Minneapolis Fed is responsible for the portion of the country that includes Minnesota, North and South Dakota, Montana, and then as you can see, we have just a portion of Wisconsin, the northwest corner of Wisconsin, and the upper peninsula of Michigan. So it's a large region geographically. It's actually the smallest of all these districts in terms of population. About half of the region's population is in Minnesota, roughly about half of the sort of economy of the region, if you look at a total output and employment, is in Minnesota as well. But it's a geographically diverse region. We have a lot of our, obviously, agriculture is a heavily important industry, but also manufacturing. Obviously, the healthcare industry is huge in this part of the country, and financial services. So it's a fairly diversified region. And one of the normal themes of the talk that I'll give in pre-pandemic times is kind of comparing the Minnesota and the U.S. economies. In some ways, Minnesota is kind of a small-scale model of the U.S. economy. But I'm not going to get into that in detail. Happy to talk about that if folks have questions. So as I mentioned, this pandemic has had really kind of, for those of us in the sort of economic forecasting and intelligence gathering businesses, as I am, two big challenges it's posed to us: the size of the shock that hit the economy and how quickly it happened. And just to illustrate this here, I have a chart of GDP. That's kind of our best measure of overall output of the economy. And I've got it indexed to where it was in 2010. So you can see how the economy was growing over the previous decade. And also so that I can put the US, Minnesota, and Wisconsin on the same chart. And just to underscore this, we have some indications that the US economy rebounded quite a bit in the third quarter. Of course, it fell a lot in the second quarter, so we're not back to where we were prior to the pandemic. But we don't know, at least per this indicator, what happened in the third quarter in Minnesota and Wisconsin, because these numbers come out with a really substantial lag. And again, this is covering the period from July through September of this last year. We won't really have our first reading on that for a while yet. Ditto with employment data. State level employment data tend to come out late in the month. So we'll actually get our October employment figures for Minnesota. I think we actually just are getting them today, midway through the month. And I'll have kind of a grain of salt to talk about with that. So if you look at total employment, again, you can see the size of this shock. It fell quite a bit. We've recovered somewhat, but the rate of recovery appears to be flattening a little bit. And I've shown both the Minnesota level on the left there, and then kind of a few of our larger metropolitan areas in the state on the right. Again, you can see I'm kind of indexed it to where it was before, in fact, a year before the latest reading. Again, we got one this morning. Minnesota unemployment is down to 4.6%. Again, kind of grain of salt to take with that figure. But we get these, again, just to kind of underscore that these figures kind of come out with a lag. I'm going to show you some more data on construction in a moment. So I just want to kind of point out construction employment, contrary to some of the other sectors, had started falling prior to the pandemic. I'm going to skip over some of this material. So just to get into kind of some of our indicators, as I mentioned, a lot of the sort of official economic statistics, they don't come out and they're very reliable. They do a very good job collecting these numbers, which is part of the reason why they come out sort of slowly. And over this period, particularly going back to April, when we were really trying to get a grip on what was going on, we had some challenges sort of keeping up with that. So just to kind of run down, I know a lot of folks in Greater Minnesota probably pretty focused on agriculture. So I just want to kind of run over some of the results of a survey that we do on a quarterly basis of our ag bankers in the region. So this isn't really a scientific survey in the sense that it's not like a random sample of farmers. It's really, you can think of it more as a panel of experts. A lot of our community banks in the region are heavily concentrated in agriculture, and so they know a lot about that industry because those are their customers. Kind of surprisingly positive results in the third quarter of this year. And again, these are backward looking. So the survey covered July through September. but it was conducted at the end of that quarter in October. So we just released these results last week. Not surprisingly, about agricultural incomes were still kind of constrained compared to a year ago. That's been the case for a long time. But however, we had, and I'll show you some charts in a second, we had a larger proportion of lenders reporting that income was flat or increased. The outlook for spending, both on capital equipment and households, was flat. The household purchases by farms was flat, and capital spending was down. But the big picture to take away from this is actually that the outlook among these lenders for the fourth quarter was pretty positive. And that was, they kind of cited a number of different factors for that. Generally good crop conditions, particularly in Minnesota this year, but also in the other states as well, tempered a little bit by some drought that developed later in the season, some recent rally in commodity prices, but in particular, the federal aid through the CARES Act that was targeted toward agriculture. And in contrast to what we've seen over the last few years, we had some reversal in land values actually seemed to pick up over the quarter. I'll just go through these really quickly. What I want, actually, I'll skip over that real quick because I want to show you kind of where the last results came in. Like I said, 39% of the lenders we surveyed told us that farm incomes were down relative to the same quarter in 2019. That's not great, but it's actually better than what we've seen typically in recent quarters. So this is the percentage over time that told us that farm incomes increased or stayed flat. And it's back, at least in the most recent survey, was back toward the level that we saw at the tail end of the last boom in farming. And again, the big picture to take away from this, about a third of lenders actually expected to increase farm incomes in the fourth quarter of this year, again owing to bountiful harvests and some improvement in prices. And in fact, since we did this survey, there's been some continued increase in some of those core commodity prices, in part because some of the USDA reports that they put out were revised downward, both at an international level and for national production as well. So sort of surprisingly positive outlook, but we still did have a quarter of the lenders, and again, this is in the region as a whole, but a quarter of the lenders told us they expected incomes to fall further. These results were better for Minnesota, again, owing to better crop conditions in the state compared to some of our neighbors. Real quick, I'm just going to show you what we saw for land values. Surprisingly, like I said, increase 3.1% for the district as a whole year over year, increase of 2.2% in Minnesota. And this comes on the heels of a period of slowly falling farm incomes. And of course, as many of you in the audience know, there was a boom in land values in the early part of the last decade. And that kind of peaked, and they've slowly retreated from their highs since then. So this was a little bit of a surprise. Cash rents also up, but not as much. So that's kind of our rundown of our ag sector, right? What we're seeing right now. I share with you the results of a survey that we just released of construction firms in the 9th district. It covers all of our region. About half of the firms were based in Minneapolis, St. Paul, but it represents construction firms in a variety of sectors: residential, commercial, industrial, and then also both contractors and designers, engineers. So pretty broad swath of folks in the construction industry. They're a little bit, in that case, conditions in construction have turned down a little bit relative to earlier in the year. So construction actually fared pretty well in the early phase of the pandemic when the rest of the economy was on lockdown, because generally speaking, most of these businesses were classified as essential businesses, and actually people started spending a lot more, particularly on residential construction. In the early part of the pandemic. I'll show you some more info on that in a moment. But what I want you to take away from this chart, so this is just a breakdown of the responses, folks telling us whether their revenue was up, down, or unchanged, and we allow them to say whether revenues were up or down a lot or a little. So you can kind of see that breakdown there. Green is increasing generally, and red is decreasing. And there's several different periods of comparison here. So we asked them to compare to a year ago, and we asked them to compare to the previous 3 months. And what you can take away from this is that compared to the last 3 months, there's been some slowdown, but in particular, the expectations for the coming 3 months at the time that we conducted this survey were a little bit more pessimistic. So roughly half of the construction firms that we surveyed here were expecting some decrease in their revenue over the last 3 months. Breaking it down by sector, again, you can see that the residential sectors fared a little bit better here than the commercial and industrial sectors. Kind of a forward-looking indicator, we have a higher or some increase in the number of project cancellations relative to a year ago. But generally speaking, most of these firms were telling us that they didn't see much change in cancellations. The bigger thing that I want to point your attention to is bid activity. There's been a big decrease in the sort of pipeline of, or at least a lot of these firms are reporting to us that there's been some increase in or decrease in the pipeline of future products and projects. The number of requests for proposals out for bid have declined compared to July levels, according to a good chunk of these firms. And again, this varies a bit by sector. And as I mentioned, residential construction, relatively a bright spot. You got a lot of people sitting around their houses right now and thinking about improvements they can make. And you can see that if you go to a hardware store or a big box home improvement store. Those are quite busy right now, and residential activity is quite busy. We also asked them, so the Federal Reserve has a lot of interest in labor markets. It's part of our job is to keep inflation under control and to try and keep unemployment down. So we asked them about their expectations for hiring. A higher share of firms were actually increasing their workforce than cutting, but they expect that gap to narrow over the coming 6 months. So about a quarter of firms told us that they were planning on cutting workforce either for seasonal reasons or for other reasons. And then a large chunk told us that they weren't planning on making any changes to their overall size of their workforce. But still, not surprisingly, to those of you who are familiar with the construction industry right now, a large portion of these firms telling us that the availability of construction workers is very tight. And you can see this in their expectations for wages. Wage pressure is expected to accelerate over the coming year. So if you look at these kind of greener shaded, those are expectations for wage increases anywhere from 1 to 3%, 3 to 5, or 5%. Wage pressure since the start of pandemic was a little bit more tepid, in particular for unskilled workers, but the demand for skilled trades workers is still pretty substantial, and so they're seeing they've seen stronger wage pressures, and they're expecting higher wage pressures over the coming 12 months. And then also, not surprisingly, if you're familiar with, if you've been to a big box home goods retailer or tried to buy some wood recently, you know that construction materials have gotten quite a bit more expensive. And that's been going on for several years prior to the pandemic. I think a lot of folks weren't expecting that to continue or even accelerate during this period. But that's again largely been due to kind of surprising strength in residential building. And so you can see here, we've got about half of the respondents told us that since the onset of COVID, they've seen increases in the cost of construction materials by 5% or more. And there's the outlook is kind of a little less on either end. So more people expecting increases, kind of lower increases, and fewer people expecting construction materials prices to continue growing by double-digit percentages. Good, just to kind of end these results on a bit of good news. A majority of firms that we surveyed told us that they would be able to stay in business even if current economic conditions, that is to say the pandemic, could persist for longer than 6 months. Only 3% say that they couldn't last more than a month, And again, the vast majority would expect about 70% expect to be able to stay in business even at current conditions. So that's kind of an outlook for a couple of different sectors that I think are a pretty important part of our economy in the state: agriculture and construction. As I mentioned, the Federal Reserve has what we call a dual mandate. We try and focus pretty closely on, Congress actually requires us to make monetary policy in such a way as to try and achieve stable prices, so low inflation, and full employment, so low rates of unemployment. Not surprisingly, we saw a big increase in unemployment in the beginning of the pandemic as a lot of workers were furloughed as we went into lockdown mode. Unemployment in Minnesota tends to be lower than it is nationally, and it didn't rise as high during the worst phase of this pandemic. But both nationally and in the region, we're seeing unemployment actually come down fairly quickly relative to how much it jumped early in the year, but it is still quite a bit more elevated relative to the level prior to the pandemic. Again, the reading this morning that it looks like we're getting on Minnesota unemployment is it's down now to, I think, 4.6%. And apologies for not having that in there, but that number was literally just released. And just a kind of a quick sort of word of caution on that. It looks like some of the recent reductions in the unemployment rate in Minnesota are due to falling labor force participation. What do I mean by that? So let me break down what exactly the unemployment rate is measuring here. We have a couple different ways of measuring labor markets. These are both statistics that come from the Bureau of Labor Statistics, the Federal Department of Labor. And you can measure the total change in the number of jobs. That's what we refer to as employment. You can measure the percentage of people who are out of work but are looking for work, and that's unemployment. They're kind of two different ways of getting at conditions in the labor market. The way we get the unemployment rate is by calling up households and asking folks, are you working right now? If they say yes, obviously they're counted as employed. And if they say no, then the surveyor asks them, are you looking for work, or are you actively in the labor market, or would you like to be working? And if they say no, they're not working, but yes, they're looking for work, then they're counted as unemployed. So importantly, the unemployment number doesn't count. It doesn't count, of course, people who are retired. It doesn't count people who are full-time parents, stay-at-home parents, or full-time students. But importantly, it also doesn't include people who've just decided they're not going to be in the labor force anymore because either they don't want to work, they don't think they can find a job, they're discouraged. Or in the case of the pandemic, the sort of additional challenge is people who've decided it's not safe to return to work. Another thing we're seeing a lot of right now is people deciding to stay out of work because they need to now become full-time care providers for their children. And so I just kind of want to caution that the unemployment rate can come down because more people are working, more people are finding jobs. It can also come down because fewer people are in the labor force. And we've seen some of the recent reduction is due to that kind of dynamic. And you can see this in the unemployment insurance claims. So two things I'm showing you here. Initial claims and continuing claims. So initial claims are people filing for unemployment for the first time. You see that unprecedented record spike in late March when we started to go into shutdown. Those tapered off actually fairly quickly, but there's still a lot of people filing continuing claims. So those are people who've been on unemployment filing to continue their benefits. And that's been tapering off. But more slowly than those kind of initial claims. Continuing claims are they're now back to slightly below the level that they were during the Great Recession back in 2009 after the financial crisis. We in our peak, we got quite a bit higher than that. So that is to say, during the Great Recession, the peak was about 8% of people in the labor force, or 8% of the labor force were filing continuing claims for unemployment. And in the pandemic, we got up to almost 10%. right now. And actually, again, some of these numbers have just been revised recently, but we had a recent reading right around 6%. There was some news just this morning that nationally unemployment insurance claims just increased for the first time in about 6 weeks. Or in about a month rather. And again, that's probably consistent with some of the increase that we've seen in cases and states going back into lockdowns. A little bit of a kind of surprising result in the construction sector. They're seeing a similar trend in unemployment claims, despite the fact that businesses who are actively in that sector tell us that the labor market is very tight. Happy to answer questions about any of that, but after I'm done here. But now I just want to turn real quickly over to some of the other indicators we've kind of looked at over the course of this pandemic. So again, I probably don't need to tell you all what's been happening over the last year. We saw a really big drop in economic activity in April as states went into lockdown, and then some recovery over the course of the summer. It's been very, and again, kind of sort of differently from typical recessions. And typically in a recession, you see most industries contracting at the same time. In the case of this pandemic-induced recession, it's been pretty mixed. Some sectors are recovering more quickly. Some sectors weren't impacted as much. Obviously, if you're in the hospitality industry or you're in the restaurant industry, you've been hit more than others. Nationally, the GDP reading that we got for the US was strong. The manufacturing industry is doing pretty well. In fact, a lot of the manufacturers I speak to are more concerned about being able to keep up with demand, but that varies a lot depending on what kind of products you produce. So that's where we were prior to the current surge in cases that we're seeing right now. And of course, was sort of an active matter of debate whether or not Congress is going to pass another round of fiscal stimulus. So I want to share some indications of the sort of outlook that we have from consumer sentiment. Real quickly, though, I'm going to show you another reading on the labor market, which is kind of a measure of the number of job postings. We get these from Indeed. So again, you can find some of these charts I'll be showing you just now. You can find on our website, minneapolisfed.org. So this is a weekly reading on the number of job postings. We actually get these, in fact, we get these on a daily basis. And you can see we're comparing to where we were a year ago. So at the beginning of March, not surprisingly, because the economy was growing at that point, we were up from a year ago in the number of job postings. And I want to flag just Minnesota is that sort of navy blue line. It's actually at the bottom at the end of this chart. I put these in year-over-year percentage terms so you can kind of compare the different states in our region to the US. You can see they've all followed a fairly similar trend. South Dakota fell quite a bit, just like the other states. It's recovered a little bit faster, but has kind of flattened out recently. But generally speaking, the states in our region are following a similar path. We're still quite a bit below where the number of job postings were a year ago. So that's kind of a measure of labor demand. I want to point out that there's a lot of discussion about lockdown measures and their impact on the economy. And the case I'm going to make to you right now before I kind of turn it over for questions is just to kind of run down how a lot of what we're seeing is actually due to people making their own decisions based on the risks that they perceive. And you can see that in some of these economic indicators kind of weakening recently as case counts have gone up. So a lot of, I think, attention has been paid, and not wrongly so, to the state level decisions to go into lockdown and the effect on businesses. But most of our economy is driven by consumers, and consumers are making the decisions they're making about whether or not they want to go out, whether they want to leave their house. And bottom line, I think until the virus is under control, we're not going to see really sustained, robust recovery. And you can see that in some of the hiring and job numbers as well. So here's just a kind of, again, a quick rundown on some of the indicators that we have on our website. You can see it's not news to you to say there's been a big increase in cases, both in Minnesota and especially in our neighboring states. You can see North and South Dakota there. This is cases per thousand again, so you can put some of these smaller states on the same axis. And I'm also showing you on the right here the positivity ratio. So that's the percentage of tests that are taken that the patient tests positive for COVID. And so I show this to you to point out that the increase in cases and infection rates is not simply due to a higher rate of testing. A higher percentage of people who are getting tested are testing positive. So that's an indication that we have that this is increasing at a community level, and it's not just as a result of doing a better job at testing or tests being more available. Resultingly, you can see some sort of retraction in economic activity. So we have a number of different indicators on this website that show us kind of measures of foot traffic. So we get this information from cell phone providers. Most of you, I'm sure, use a smartphone. If you have your location services turned on, and if you have your work flagged, it can tell us at an aggregate level we're not following people on an individual basis. These are anonymized data. But it can tell us how frequently people are going into work. And you can find that on our website. I'm not going to walk through all these charts. But we can also track whether people are going to grocery stores, whether they're going to restaurants. And as you can see in that chart on the left where I've circled, visits to bars, and you'll see this trend for restaurants as well, have tapered off in recent weeks. And that's true both in Minnesota, and it was true in Minnesota before the governor announced the latest round of restrictions. And it was also true in some of our neighboring states where restrictions haven't been as tight. In South Dakota, where they've, at a state level, they've done very little to restrict mobility. People are looking at the risks and making their own decisions to stay home. And so you see that reflected in some of these data. And again, I could spend more time talking about these, but I do want to leave time for questions. I'll show you just on the right here. These are reservations. Obviously, these fell to zero during the early phase of the pandemic when in restaurant dining was closed, and they recovered somewhat over the summer. Still well below where we were a year ago. And part of that is due to capacity constraints, but also due to the decisions that people are making because of the risk from the virus. So the point I want to make here is that I think a lot of our debate, and again, I don't think it's wrong to focus on the policies, because that's sort of something that we have under our control, but a lot of it has focused on state level decisions in state lockdowns and the economic impact of those. But a lot of the actual economic shock from this and the change in behavior is due to consumer behavior and consumers, again, making those decisions based on their perceptions of risk. And so we're really not going to see a sustained robust economic recovery until the virus is under control, because people are going to be staying at home. They're going to be deciding not to go out and spend money. And again, happy to answer more questions about this. And you can find out more of these charts on our website, minneapolisfed.org. I'm gonna turn it over to Q&A now, but I'm just gonna put up my email address up on the screen in case any of you have questions. Something I said and you don't get to ask about it right now, and you want to follow up with me, please feel free to reach out to me. And if you're interested in a speaker for a different event, please feel free to ask. I also have some colleagues that do speeches like this as well, and look forward to hearing from you. So with that, I'm going to shut up and take some questions.
Great, thank you, Joe. As we anticipated, you packed in a ton of data and a ton of information in a very short period of time, so we appreciate that. We've got a handful of questions that have come through. Feel free, if there's still things top of mind, we can still take a few more questions. I always like to start off a Q&A session with a nice slow pitch across the plate. So Joe, we spent the past hour with this group talking about politics and the state of the election at the federal level and at the state level, with Minnesota being the only divided legislature in the country again. How big of a concern is the political climate from your viewpoint in economic recovery going forward?
So how big of a concern is it? Let me say a few things about that. I do a fair amount of both formal surveying and then informal talking to businesses. I hear a lot from businesses, I did hear in the year leading up to the election that the amount of uncertainty around the election was really weighing on them. They were very concerned about that. So I know that's a real thing. I think if you look at the sort of broad historical sweep, though, changes in administrations don't necessarily have a huge impact on the economy. I think that people kind of overplay the extent to which whatever party is in power is good or bad for the economy. And I could say more than that. Obviously, we're living in different times right now, and when I say that, what I mean is, as I've just made the case that that it's really the pandemic that's driving the recession that we're experiencing right now, and will drive the recovery. And our ability to get that pandemic under control is going to drive the recovery. Now, a vaccine, there's been some more positive news about vaccines this week. That's going to be great. We all know it's going to be a long time before there's actually adequate doses to get a large share of the population inoculated. So, and again, speaking for myself and not necessarily the Fed, it's my view that that getting the pandemic under control, and that means in some cases very strong social distancing measures, masking mandates, and those sort of measures are ultimately going to be better for the economy, because you get the pandemic under control and we can sort of resume life as normal more quickly. And we did see that over the summer when infection rates started to go down, because that first wave of lockdowns was substantially successful. There are those who will argue now that we didn't do enough at that time, that we didn't get the pandemic under control enough, or that we sort of took the foot off the brake too soon. That's not really for me to say. I'm not an epidemiologist. But just looking at the economic data, it certainly did improve over the summer when folks were feeling a little bit more confident about being able to go out, and we're seeing retraction in that right now. So I think that, contrary to normal, maybe the political climate and elections might have, say, more of an impact long term on policy. But again, I do think that people tend to overplay that.
And as we look at the pandemic recovery, and obviously there's good news coming out on the vaccines, and things look positive that they'll start rolling out relatively soon. And we've seen positive news on the state budget numbers from what was projected back in May on the monthly receipts. As the pandemic wanes, should we anticipate a quick recovery, a gradual recovery, or is there a threat of this K recovery that some economists are talking about, or we're talking about?
Yeah, so I'd like to talk about the K-shape in a moment, but let me just start first by saying that, I actually, before the pandemic, I did a fair amount of speaking about the economic outlook, and I would always say that economists got into the business of economic forecasting because we felt bad for weather people, and we wanted to make them look better. Economic forecasting is sort of just hazardous by nature. I happen to sit on actually the advisory council for the state, the Council of Economic Advisors, that sort of weighs in on the state's budget forecast. And I will say those numbers, the most recent numbers, show some improvement since the middle of the year, and that's because the forecasts that they were looking at in the middle of the year were expecting much slower recovery, and the actual growth that we've seen in the months since then was much more positive, both at a national level and for what we can say at the state level. And so that just sort of underscores that, doing the best job we could at the time forecasting in May, things look pretty dire, and they've actually improved a little bit faster than we expected at that time. So that just kind of underscores that economic forecasts, even in normal times, are hard to do, and especially when you're dealing with something like the pandemic, that's just by its nature impossible to predict, is even more difficult. I want to talk about the K-shaped recovery thing because you brought it up. So a lot of times people talk about economic recovery as being V-shaped. Is it a quick recovery or L-shaped? Is it a slow recovery? The K-shape is an interesting analogy folks have been turning to recently, because what we've seen is so far is a fairly rapid improvement in economic conditions for people who are well off. And the people who were most severely impacted by this crisis have been the lowest income and most vulnerable segments of society. Again, just to put in another plug, we have more information on this on our website. You can kind of look at income changes by economic category, by income decile or quantile rather. And you can kind of see that, again, higher income earners have seen their incomes recover faster, and that's because largely the people who were most impacted by layoffs and furloughs were lower income earners. There were people who worked in service professions. Those of us who were fortunate enough to work in offices were able to go to a work from home environment. And we were already doing pretty well prior to the pandemic. So that I think that K-shaped recovery is a real concern, where the people who were sort of worst positioned to withstand the impact of this have been most negatively affected, and the long-term consequences of that are extremely concerning.
And building on that, what do we know about the Minnesotans who are unemployed right now, and more concerned about what do we know about the people who are choosing to just leave the workforce, as you referenced?
Yeah, so I think a huge it's sort of an active area of research right now, so we're kind of learning about it. But I think there's a huge portion of people who are leaving the labor force right now are people who are deciding to, or maybe they didn't decide to, maybe they had it forced on them, having to become sort of full-time care providers and part-time teachers for their children. So you're seeing a lot of families having one parent stay home. If somebody loses their job, they may be, and in fact, that describes my household right now. My wife unfortunately lost her job earlier this summer, and she's sort of taking care of our young daughter full time. Fortunately for us, she's too young to actually be in school, so we don't have to deal with the homeschooling that I know a lot of parents are struggling with right now. But I think that's a huge portion of the reduction in labor force participation that we've seen, is people having to step away from work to be full-time care providers for their children. How quickly that changes is anyone's guess. Once we go back to in-person school on a more sustained basis. But that's a large part of the story. But also people who they're in high-risk professions and are deciding not to go back to work. There's a lot going on there, and of course, I would be remiss if I didn't mention a lot of businesses I know are really focused on the enhanced unemployment benefits that were in effect earlier this year, and the fact that those might be a disincentive to return to work. There's more that I could say about that if you want to talk about that more, but I'll leave it at that and see if you have any more questions first.
So obviously, one of the things we work on closely here within the coalition is state investments and the state budget and tax policy and so on and so forth. Looking into your crystal ball, and obviously you indicate you have a little bit more of a clearer ball being involved in some of the conversations at the state level. What do you think we should be anticipating for the next 12 to 24 months? Early numbers had said that the state was probably going to be facing a $4.7 billion budget deficit for the upcoming biennium. Are things looking better than that? Do we still need to be concerned about the budget? Just any insight or advice that you have for us moving forward from that standpoint.
Well, I'll have to defer to my colleagues at Minnesota Management and Budget on that, and the budget forecast that they're going to be releasing later this year. I think just in terms of just in kind of general terms, the budget is the revenues are obviously a pretty direct correlate of economic activity, GDP growth. So to the extent that we've seen faster recovery in GDP than we were maybe expecting earlier in the year. That's a good sign. Now, it needs to be pointed out, like I mentioned earlier, national GDP, U.S. GDP growing at 33% in 33% annual rate in the third quarter is the highest we've ever seen it. But of course, it fell much more than that earlier on, so we're still below our pre-pandemic level of GDP and have some ways to go before we get back there. The bigger question is, I mean, obviously you don't expect that kind of growth on a sustained basis. That reflects some kind of recovery in the level to back to where we were at prior to the pandemic. The bigger question is sort of what you expect for growth going forward into the next year. I'll just say, some of the economic surveys that we've done, we released a survey of professional services firms earlier this year, and just to kind of put in a sneak preview, we're conducting a survey of manufacturers that we'll be releasing in January. And overall, the services firms that we surveyed at the middle of the year had pessimistic expectations for the coming year. So they weren't necessarily expecting at that point for the economy to continue growing at a gangbusters rate into next year. They were expecting fairly tepid growth for the coming year. So I think that's really the key thing, is what sort of growth do you expect into 2021 and 2022 going forward? And again, it's kind of hazardous to make a prediction on that, but I think if you look at kind of the overall consensus of macroeconomic forecasters, they're expecting fairly weak growth after the middle of next year.
And then just in a last question here, looking at the Minnesota versus their neighbors versus the region, lots of people talk about how fortunate we are in Minnesota with the diversity that we have in our economy. Is that something that you would see with what you're seeing Minnesota versus other states as far as our resiliency on being able to wander through these troubled waters?
Yeah, I think, I kind of want to, I'll make a case real quick, since this is maybe the note that we're ending on. It's great to point out the diversity of Minnesota's economy, that we don't, we're not sort of reliant on one industry or another. But a big part of the reason for that is because our labor force is so educated. We have a very talented and highly educated labor force. We attract educated workers from other parts of the country. And that's really the strength of our economy. That's what allows our economy to be diverse and to thrive. So I think it's really important to continue making those investments, but it's also important to point out that these are averages, and that doesn't include everybody in the state's labor force. And we want to make sure that we're not leaving folks behind. And we do know that we have major challenges in this state around opportunity gaps and the racial wealth gap between white Minnesotans and Black Minnesotans and Minnesotans of color. And I think that if we really want that diversity in our economy and the strong human capital in our labor force to continue being a strength going forward, we need to address that opportunity gaps. I think that long term, that's the biggest policy challenge this state faces. Short term, medium term, we're in good shape. The economy here is very strong, but that structural inequality is something that needs to be addressed long term.
Great. Well, thank you for taking the time today, Joe. We really appreciate it. This has been insightful, and hopefully for our mayors and council members and city administrators, helpful in helping them think through where we go from here.